Hi guys, so this is the third and final revision video that is designed to help you revise for Unit 1 of the VCE Business Management course. The focus of this video is the internal business environment. This is the second topic which makes up a larger unit on planning a business, the other component being the external business environment, which I dealt with in the previous video. In this video, I'll break the topic into 9 areas. It goes a little bit longer than the other two, I think, but if you're using this for revision, feel free to pause and take notes. Like with the other 3 videos, the level of depth that I can go into in this one video is limited. However, if you come across a topic which you are not totally familiar with, make a note of it and go and look at it further after this video. You can repeat this process to iron out any gaps you have in your knowledge on the topic, just like you would the other 2 videos I've created. So without further ado, let's get into it. This first section, business resource needs, is a very brief and simple topic. The 2 main things you need to get from this topic are an understanding of what resources are in terms of a business context and understanding of the 3 main categories of resources used by businesses. So firstly, a definition. Resources refer to all the people and objects that are needed for the business to function properly. Pretty simple. There are 3 categories of resources that a business needs to plan for, those being natural, labour and capital. Natural resources are taken from the environment. Labour resources refers to the knowledge, skill and effort requirements from humans that a business needs. And finally, capital resources are the equipment, tools and machinery that are used to maximise labour efficiency and contribute to the production of goods or performance of services. To attain these 3 resources, often a business will need to tap into its sources of finance, which will be dealt with in the next section. So there are 2 types of finance sources available to a business, internal and external. When a business owner contributes their own funds, this is called equity, or in some settings, capital, which is very common at the startup phase of a business. Equity funding is referred to in this course as internal funding because it is coming from within the business, as it is the owners who are funding it. Having an IPO and selling shares in a company is another form of equity funding, as the purchasers of the shares in an IPO are handing over money to become an owner of the business. Businesses then use the money raised from selling shares to further develop the business. Next, we have external finance. As the term suggests, external finance is money a business gets from sources outside of the owners of the business. The most common external finance is debt. There are a range of debt instruments available to businesses, the main forms being bank overdrafts, bank bills, trade credit and mortgages. The type of debt finance a business may utilise would vary depending on the nature and assets held by the business. For instance, for a business such as a farm, where the business only earns revenue 1 or 2 times a year, short-term debt facilities are very useful to cover everyday expenses. For a large chain supermarket which receives thousands of litres of milk a day, it is practical to have a trade credit system in place with the supplier so they don't have to expend time on the administration of making payments every day. Or if a business owns property but needs cash, remortgaging a property is a good option to get access to a large amount of cash at a low interest rate. Other external sources of finance which would be less common are government grants. Finance is a fundamental part of running a business, so understanding it as a potential business owner is very important. Some considerations in financing activities of a business that should be considered include the flexibility of the finance, the availability of finance, and the level of control maintained by the business. When it comes to equity and debt financing, if you need to raise money for the company, you need to weigh up paying back a loan with interest to giving up a percentage of control when doing an equity raising. Different types of businesses will be suited to different locations, and the business owner must consider a number of factors when determining the most appropriate location for their business. Factors to consider include the nature of the business, visibility, cost, proximity to customers, suppliers, competitors, and complementary businesses. So for example, the location needs of an importer or exporter would be very different to that of a bricks and mortar clothing store and even an online business. A number of different legal ownership structures are available to a person wishing to establish a business. The most common are unincorporated businesses such as sole traders and partnerships, which each carry particular legal requirements and responsibilities. Unincorporated businesses are simpler to set up. However, the owners of these types of businesses assume all liability. This means that they are personally open to litigation if the business is sued. Also, unincorporated businesses have their profits taxed at the individual marginal tax rate, which if the business is earning more than $180,000 in profit per an owner each year, they will be subjected to taxes of 45% at the top rate. On the flip side, incorporation allows a business to become a company, which is a legal entity separate from its owners. This provides the benefits of limited liability to those owners, meaning in legal disputes, the owners are not personally being sued. Private limited companies and public listed companies are the two main types of incorporated businesses. A publicly listed company is one which appears on a stock exchange. In Australia, the primary stock exchange is the ASX, but there are small ones such as the Bendigo exchange. Incorporated businesses are potentially advantageous if they are quite profitable, as corporations in Australia only have to pay a 30% tax rate flat on all profits. To better illustrate this tax benefit, let's take two businesses, one being a sole trader and the other being an incorporated business. Say in the 1 year, both businesses made a $500,000 or $500,000 profit. In this instance, the sole trader would have to pay $198,097 in tax, whereas the incorporated business would be saving $48,000, as they would only have to pay $150,000 tax because they pay a flat rate as opposed to the marginal rates of the tax bracket system. If those same two businesses had a less successful year, you'll find that the sole trader may be better benefited. So let's assume a $50,000 profit for the year. In this instance, the sole trader would only have to pay $7,797 in tax, whereas the incorporated business would have to pay $15,000. I just want to make this point that when deciding to be incorporated or unincorporated, potential profitability of the business is a pretty major consideration. A business model is the way in which the business will run its operations to generate a profit. The business owner will select a business model that meets the goals of the business. Common business models include online businesses, bricks and mortar businesses, and importer-exporter businesses. With the increase of e-commerce, many businesses have some sort of online presence now, either through a direct presence such as an online shop or through a third-party provider such as Uber Eats in the restaurant industry. Buying a franchise to use an existing brand name and reputation is a popular business model. This is because it gives you an already proven business model that you have to follow, like an instruction manual. The most obvious types of franchises we see here in Australia are the fast food chains such as McDonald's, KFC, and Porto. By running a franchise, the business owner, known as the franchisee, usually has to pay a licensing fee and a percentage of profits to the franchise owner. Another business model is the social enterprise. This is a business that produces goods and services for the market but operates with the primary objective of fulfilling a social need. A good example is the Thank You brand, which diverts a percentage of all profits to improving access to clean drinking water in less developed parts of the world. A business owner has access to a number of other businesses or individuals such as solicitors, accountants, and banks, which provide expert professional advice and support in the areas of law and finance in return for fees and remuneration. Various levels of government and not-for-profit organisations also provide a wide variety of support services for businesses such as technological advice. Business owners can also choose to join support networks. Support networks can be both formal and informal. Examples of formal networks include Chambers of Commerce, the Victorian Chamber of Commerce and Industry, or VCCI, Small Business Associations of Australia and New Zealand, trade associations, and government organisations. Informal networks include networks of friends, colleagues, and local business owners, often many of which can be met through more formal networks. Often there are many community-based services available to business owners. These include business enterprise centres and small business centres Victoria, which help provide localised support for businesses. A business mentor can also be a valuable source of support for business owners. Mentors provide valuable guidance to a business owner and are utilized by businesses at all stages of the business life, from startups to growth phases to matured businesses. Planning is an essential part of establishing and running a business. A business has many tools available to assist in the planning process. Three common sources are market research, SWOT analysis, and a business plan. Market research can allow a business to get a better understanding of its customers and competitors through research. A SWOT analysis helps a business identify its internal strengths and weaknesses, as well as external opportunities and threats. A typical business plan includes an executive summary, operations plan, financial plan, and marketing plan. A good business plan is an active document that evolves along with the goal orientation of the business. It is a fundamental document in starting a business as it provides key information about the business to potential investors and financiers. It has been estimated that 50% of new businesses have failed in their first 3 years. This highlights the fact that starting and running a successful business from scratch can be challenging. So for someone who is motivated to run a business, the idea of owning a business that is already established is sometimes an attractive alternative to starting one from scratch. But be warned, there are also issues that can be associated with buying an existing business. Purchasing an existing business is likely to benefit a business owner who is seeking instant income, as it already has working systems in place, as demonstrated through its proven track record. While you inherit all of the business strengths when you purchase an existing business, you also inherit the business's weaknesses. Often these weaknesses can be hard to pick up on before purchasing a business, as this could be a potential leverage point when negotiating the price of the business, therefore making it in the interest of the seller of the business to not draw too much attention to these shortfalls. What constitutes a weakness of the business can vary on almost all aspects of the business. Basically, anything that can go wrong with the business is a possible weakness that the purchaser may be inadvertently acquiring. On the flip side, establishing a new business, despite the challenge to develop and achieve success, is likely to benefit a business owner who has recognized a gap in the market or who has developed a totally new product, as they can be more flexible with the design of the business and are not constrained by the legacy of an existing business. Corporate social responsibility management issues is the final subtopic of this video. It deals with a movement in thinking among businesses which has become increasingly prevalent in recent years. At the heart of corporate social responsibility management issues is the idea of how a business can act in a way that is good for society. Two particular areas that we look at in this course are in the areas of doing the right thing by people and doing the right thing by the environment. A business should consider how it can go above and beyond legal requirements to improve the welfare of its stakeholders. A failure to act in a socially responsible manner can result in customers boycotting the business's goods or services, as well as employees leaving due to low staff morale. A business owner should consider the potential impact of the business on the environment when planning. The owner may consider conducting an environmental audit and setting up an environmental management system. A business owner should plan to ensure that the needs of customers are taken into consideration. A business owner should ensure that staffing issues are considered when planning. For example, safe and healthy working conditions for employees above and beyond legal requirements should be established. Fair wages should be provided regardless of where employees are from, and a business may also consider employing workers from disadvantaged groups. Business owners should plan to ensure that policies are in place that reflect a commitment to corporate social responsibility. In topic 2, when studying corporate social responsibility, you were introduced to the idea of triple bottom line planning, which is an approach to business planning that incorporates social, economic, and environmental aspects as part of the planning process. Well guys, that brings us to the end of the video. Hopefully it has given you a good overview of what topic 3 of the business management course is all about. Like I said at the start of the video, if you found that you need to go back and look at some of the areas of this video in greater depth, go and do so, and then revisit the video to see if you can identify any more gaps in your knowledge that may need attention. Well, that's it. I hope you enjoyed it. Happy studying. Take care. See you later.